So we've looked at stock picking. Now let's explore time picking, better known as market timing. Market timers claim the ability to predict the future movement of the stock market, getting into the market before it goes up and getting out before it goes down. However, numerous studies from industry and academic experts demonstrate that market timing is a bad idea. In his 1975 study, Likely Gains from Market Timing, Nobel Laureate William Sharpe calculated that a market timer must be accurate 74% of the time in order to outperform a passive portfolio at a comparable level of risk. So what percentage of times do market timing gurus get it right? CXO Advisory Group tracks public forecasts of self-proclaimed market timing gurus and rates how accurate they are. For the period from 2000 to 2012, the researchers found that not one of the gurus was able to meet Sharpe's requirement of 74% accuracy.
In short, the reason that market timers do so badly is that nobody can see the future. I mean, this should be obvious to investors that the future is an unknown. We don't know what's going to happen a month from now, a day from now even. And this random, unpredictable news is what drives prices.
There are two big challenges for market timers: being in the market on the best days and out of it on the worst. The problem is there are very few of either, and both are very hard, if not impossible, to identify in advance. Professor Najat Saihan analysed 7,802 trading days from 1963 to 1993 and concluded that just 90 days generated 95% of all that period's market gains, an average of just 3 days per year. As we've learnt, markets are essentially efficient. Prices incorporate all known information. Something that advocates of market timing often fail to grasp is just how quickly new information is devoured by market participants. In his book, Analysis for Financial Management, Robert C. Higgins writes, "The arrival of new information to a competitive market can be likened to the arrival of a lamb chop to a school of flesh-eating piranhas. The instant it hits the water, there is turmoil as the piranhas devour the meat. Very soon, the meat is gone, leaving only the worthless bone behind. No amount of gnawing on the bone will yield any more meat, and no further study of old information will yield any more valuable intelligence."
If you turn on just about any financial news program at any point in the day, it won't be long before you'll hear a broadcaster talk about the future direction of the market, such as the market's going up or the market's going down. And the use of that phrase, going, actually is the reason that investors want to trade. If you hear it's going up, why would you want to buy some of that? And if something's going down, you certainly want to sell it. So why do they do this? Well, in essence, they're encouraging their viewers to call their stockbroker and place trades. And why is that? The advertisers for these financial media programs benefit from trading. It's their business model to make money when people trade. And so when investors can learn that these future trends don't exist, all you can say is the market has gone up or the market has gone down, they will move a lot closer to this idea of being a passive investor.
People invest because they want a return. Buyers pay a price that reflects the risk associated with capturing that return. So a fair price equals a fair expected return. Now, prices may subsequently go up or down depending on new information, but it's best to assume at the time of a trade that the price is a fair one. Time pickers like to think they can predict future market movements, but they can't. Why not? Because they can't predict the next news story. There's no competitive edge that exists other than illegal inside information. The best thing to do is to invest for the long term in a low-cost portfolio of index funds.